Greetings, class, and welcome to Accounting 201. This is the comprehensive problem that we worked in class the other day. I told you I would go through and finish up the journal entries, but I realized that there was one journal entry in here that I looked at the incorrect way, and I wanted to clarify it for you and explain what was going on. So these are the journal entries. And what we have to do here is decide, are they purchasing or are they buying? So if they're purchasing, they're going to come into this category here. It's going to be one of these journal entries. If they're selling, it's going to be one of these entries. And they're going to be mixed up. So we're going to have some back and forth between purchasing and selling. So in this first entry, it says August the 1st purchased merchandise from Aaron Company for $7,500 under credit terms of 110 net 30 FOB destination, invoice dated August 1. We're going to record the journal entry on August the 1st. And the debit here, we're purchasing goods for merchandise inventory. So we're debiting merchandise inventory, and I'm abbreviating it here. Well, merchandise inventory, INV. The debit will be for $7,500, and the credit will be to accounts payable for Aaron. So we are increasing both the inventory and the accounts payable. So the debit is here, the credit is here. That's the first journal entry. Then we get down to August the 5th. We sold merchandise to Baird Company for $5,200 under credit terms, credit again, of 210 net 60 FOB destination. Invoice dated August the 5th. The merchandise had cost of $4,000. So if we go back over here to this little chart that I gave you, if we are selling and we are selling using a perpetual system, we're going to have two entries, one for the revenue right here and one for the cost right here. And that's exactly what we're going to do with this journal entry. So August the 5th, we start with a debit to accounts receivable because we're selling it to a customer who's going to pay us later, and it's Baird. And the amount will be $5,200. The credit will be to sales. Now this is the retail. This is revenue. This is the sales price. This is not the cost. Because we're using, so this is the revenue portion right here, okay? Because we're selling and we're using a perpetual inventory system, we need the cost portion down here. So we're going to debit cost of goods sold. Let's go back over here and show you. So we start with the revenue here for $5,200, and we're going to use the cost here of $4,000. So the debit for here will be cost of goods sold. And that'll be $4,000. And the credit will be merchandise inventory for $4,000. Okay, I'm abbreviating here, but merchandise inventory. So those two entries go hand in hand when we're using perpetual system, perpetual inventory system. Then on the 8th, we purchased merchandise from Waters Corporation for $5,400 under credit terms of 110 net 45. So August the 8th, we're buying merchandise for inventory, so the debit is to merchandise inventory. And the debit amount is going to be $5,400. And the credit will be to accounts payable for waters for $5,400. Okay. On August the 9th, we paid $125 cash for shipping charges related to the August 5th sale to Baird. Now, when we were in class, I looked at this incorrectly. What we are looking at here is a sale. And if we go down here and look at the sales handout and say, okay, we're looking at freight charges on sales, we're going to do a journal entry that looks like this. So, when we're doing the journal entry that looks like this, the cost will go to delivery expense because we sold this merchandise to a customer, but we're required to pay shipping on it because it's FOB destination. The credit will be to cash for $125. All right. Oh, by the way, this is not August the 5th. It's August the 9th. Yikes. August 9th. Okay, then we go down to August the 10th, where we have Baird returning merchandise from the August 5th sale that cost us $400 and was sold for $600. So this was related to the sale, and we're still doing perpetual inventory. So we're going to start this by recording the sales return. And remember, we don't debit sales, we debit the contra account, which is sales, returns, and allowances. And this is the sale price, which is right here. The $600 is the sale price because it was sold for $600. So we debit that for $600. And we credit accounts receivable Baird for $600. All right. Now that's the revenue portion. Now we have to think about the cost portion because we're doing perpetual inventory. So the cost is here. It's the $400. So the debit here, because we're taking the merchandise back and returning it to inventory, because that's what they tell us, we're debiting merchandise inventory for $400, and we're crediting cost of goods sold for $400. Okay. All right. So that's the 10th. Then on the 12th, we say, well, after negotiations with Waters Corporation concerning problems with the purchases on August the 8th, we received a price reduction from Waters of $400 off of the $5,400 of goods purchased. Lowe's debited accounts payable for $400. So that tells us what we're going to do right there. So we're going to start on August the 12th with a debit to accounts payable Waters. This reduces the amount we owe them for the amount of the allowance they gave us. So we take $400 off of our account, and the credit will go to merchandise inventory because we're reducing the cost of the inventory by the $400. So it goes here. All right. Then on August the 14th, at Aaron's request, Lowe's paid $200 cash for freight charges on the August 1st purchase, reducing the amount owed accounts payable to Aaron. So what we're going to do is we're paying for the freight charges, but they're telling us we're going to get a credit on our accounts payable, or we're going to get a reduction on our accounts payable. So we're going to debit accounts payable. So the accounts payable will be debited. Accounts payable Aaron, and that's going to be $200 because they ask us to pay the freight charges of $200, and a credit to cash of $200. Okay, so we paid the freight charges for the Aaron purchase. All right, go back over here. August the 15th, we received the balance due from Baird Corporation for the August 5th sale minus the return on August the 10th. So I'm going to go down here just a minute and do this calculation. On August the 15th, we're going to get this money from Baird, but we're going to start with their account balance over here. So we have at the beginning, Baird had an account balance of $5,200, and they returned merchandise that was the sales price was $600, so we credited their account for $600. That means they have a $4,600 balance in the accounts receivable. This is accounts receivable Baird, and the debit and the credit. We take the $4,600 times the discount that they can receive, which is 2%. That gives us a $92 discount. Okay, that's the discount we're giving them for paying early. That means the net cash we will collect will be $4,508, because we're going to take this $4,600 minus 92 to get $4,508. So once we do that, we come over here to the journal entry and we record a debit to cash because they're paying us cash. And we're going to record this cash amount that we received right here, which is $4,508. And then we're going to have a debit to the sales discount, which is $92. And finally, we will credit accounts receivable Baird, and that amount will be for $4,600. Okay, that's the journal entry for August the 15th. I'll go back up here again, and it says August the 18th, paid the amount due Waters for the August 8th purchase less the price allowance. So again, we're going to have to do some calculating here. So we have the beginning balance with Waters for the purchase, and then we're going to deduct. So we have an accounts payable for Waters. We owe Waters this money. So this is going to be a credit balance. So the balance will be on the credit side. And the balance we originally purchased with them, with Waters, was $5,400. However, we negotiated a discount, or a sales allowance, not a discount, a reduced price for problems with the merchandise. So we debited accounts payable for $400 to reduce the amount we owed for that allowance. The net balance for Waters is going to be $5,000, okay? And then we're going to take that times the 1% discount to get $50 as a discount. So the $50 discount, and we're going to subtract that from $5,000, which is our actual original. Well, this is the original. This is the amount owed after we deduct the allowance. So that'll be 4,950 is the net cash that we need to pay to settle this. So this is paid in cash. Okay, so we're going to go up here and do the entry. On August the 18th, we debit accounts payable for waters. The amount will be a debit of 5,000. That's the amount that we owe after the allowance is adjusted, after the allowance is taken out. We're going to credit for this discount here, the sales discount. We won't count it as a sales discount. It'll be a reduction in cost of merchandise inventory. So we'll credit merchandise inventory. That's because this is a sale. I mean a purchase. I'm sorry. I said a sale. I meant a purchase. If this is a purchase, when we have a discount, we're going to reduce the cost of merchandise inventory. If it's a sale like it is here, we're going to take the price that they owe, the accounts receivable balance, minus the sales discount, which is going to be a sales discount. So for a purchase, we never have a discount. We always directly credit merchandise inventory, but for a sale, we always have a discount or an allowance if we're adjusting it. And then the final credit is to cash for the amount we calculated right here, which is 4,950. Okay, that's the 18th. And then on the 19th, let's go back up here. On the 19th, you sold merchandise to Tux Company for $4,800 under credit terms of 010 net 10 FOB shipping point. Invoice dated August 19th. The merchandise cost $2,400. This is a sale. We're selling this to Tux. So we're going to come down here on August the 19th, and we're going to debit accounts receivable, Tux, for the sale amount. And the sale amount here is $4,800. And then we're going to credit sales for the same amount. So $4,800. Okay, this is the sales piece or the revenue piece. Now we have to deal with the cost. So we have cost that they've given us in the problem of $2,400. So we're going to use go to cost of goods sold. For $2,400 and credit merchandise inventory for $2,400 because we're taking the merchandise out of inventory and putting it, the cost of that, in cost of goods sold because we sold it. And again, we're referring back here to these two numbers. The revenue is here and the cost is here. Then on the 22nd, Tux requested a price reduction on the sale because the merchandise did not meet specifications. Lowe's gave a price reduction, an allowance, they just told us what they did, of $500 to Tux and credited Tux accounts receivable for that amount. So they just told us what journal entry we need to make. So we go back down here, and on the 22nd, we're going to debit sales returns and allowances. And the debit here is going to be for $500, which is the retail amount of the sale. Now, because this is an allowance, we're not taking any merchandise back. We don't worry about the cost side of it. So we now credit accounts receivable, tux, for $500. Okay, let me restate that. We're only doing the revenue here because we did not receive merchandise back. Instead, we just gave them an allowance. So we're reducing the sales price for the problems that they had. Okay, then we come back up here again. Oh. Yikes. Okay, we come back up here again, and we look at the next one on the 29th. Receive tux as cash payment for the amount due from the August 19th sale, less the price allowance from August the 22nd. So we're going to figure out what tux owes, just like we did with the others. So we have an accounts receivable for tux. And originally, this is an accounts receivable, and originally we sold them $4,800 worth of goods. But we gave them an allowance because there was a problem with the shipment for $500. So the net balance for tux is $4,300. And with tux, they don't have any discount available. So that's basically, this is the amount we're going to record on August the 29th. So we receive cash of $4,300. And we credit accounts receivable, tux, for $4,300. Okay. All right. Okay, then on August the 30th, back up here again, it says that we paid Aaron Company the amount due from the August 1st purchase. So we're going to go back down here and record that. Now, on August the 30th, we have to figure out what we actually owe to Aaron. So on August the 30th, we look at Aaron's original purchase, which was that we purchased from Aaron, which is an accounts payable. So we have an accounts payable, Aaron, $7,500. We reduced that by the amount of the freight we paid, $200. So we have $7,300 as a balance. So the journal entry here will be a debit to accounts payable, Aaron, $7,300, and a credit to cash for $7,300. Okay. Well, that concludes these journal entries. And again, I wanted to go back through them all because I want to make sure you got them all in sequence and that you didn't miss anything. If you have any questions, feel free to reach out. I hope you have a great day.